Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments, and PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Jim Bethea, Chief Investment Officer of the West Virginia University Foundation, will be our guest. So listeners have a high-level sense of our roadmap. We'll start with some background, then discuss the usual. Investors and business leaders should be able to extract a great deal of value from Jim's insight. On that note, welcome, Jim.
Thanks for having me.
Our pleasure. Why don't you start with your background, how you got to where you are now, and then we can go into the objectives and more on that.
Sure. I'd like to say I have the classic CIO origin story in that I started as a mechanical engineer and designed tires for Bridgestone for 5 years and quickly discovered that I didn't want to do that the rest of my life. So I went back to business school. And this would have been the late 90s, early 2000s when everybody went to business school and got an MBA. So that wasn't too different. Along the way, during some classes that I took at Case Western Reserve University, I decided that I wanted to pursue investing. And I graduated in 2002. We just had the 24th anniversary of 9/11 yesterday. And it was not a great time to graduate with an MBA, particularly in finance. And I was lucky enough to get a job at an investment bank, Mystic Capital Advisors, and they were opening a Midwest office. So I became the Midwest office for them and really kind of did mergers and acquisitions for either the buyer or the seller. We represented those folks. And I enjoyed that. That was, a kind of a precursor to me to private equity. Didn't know what private equity was then. It wasn't the behemoth that it is today. But I did cover some publicly traded stocks and really liked that and decided that I wanted to pursue the investing side rather than the banking side. And so from there, I went to a sub-advised mutual fund shop, Touchstone Investments, where that kind of was my first foray into manager research. Did that for a few years. And my wife and I at the time kind of wanted to get out of Ohio. We were both from different parts of Ohio. We were living in Cincinnati at the time and moved out to Portland, Oregon to work at RVK, a consulting firm based there. And when you become a consultant, one of the things that happens is you always kind of put in the back of your mind, do I ever, want to work for one of the clients? And at the time, everybody kind of wanted to work for endowments, although RVK, I think to this day, still was big in the pension space, not as large in the endowment space. I kind of decided, figured out I wanted to work for an endowment at some point. Didn't know when that would be. And I really wasn't looking per se for a job, but I was traveling a lot and we were in Oregon and folks were getting old, families were growing in areas we didn't live. And we would always kind of go back to Ohio, where my parents were down in South Carolina at the time. And that was kind of a drag of, hey, it's Christmas. Now we have to pack everything up and go fly across country. I was probably coming off a flight from New York or Boston anyway, so it wasn't too fun for me. And so Iowa was looking for their first investment person. And so I was lucky enough to get the job there at the University of Iowa Center for Advancement. Did that for 15 years, built the team, helped them diversify their portfolio away from what was effectively a 70-30 stock bond portfolio into more of the classic endowment model. And I was there and, everything was fine, but I was kind of similar to being at Bridgestone after 5 years and thinking I didn't want to do this the rest of my life. I was one, I reached a point where maybe it was time for a change. And I was at a comfortable spot in my career, and I was fortunate that I could, pick my spots. And so my wife and I kind of sat down and like, where would we want to live? And that was kind of the main factor in it of where would we want to live. I wasn't going to take a job, and I was living in Iowa, and we didn't have family there. I had friends there, but it was just kind of tough being isolated from things. As folks still growing old, people are friends of things happening in their lives that we couldn't really make it back for. And so West Virginia University Foundation was doing a CIO search, and I knew a couple folks on the team and always respected Rick and knew him from different conferences and things along the way. And so that was really interesting to me, as I knew it was a strong team. And so started the interview process with West Virginia University Foundation, and just kind of everything they said was resonating with me about what I wanted from the next step in my career. And so fortunate to get the job here. This is finishing the 14th week here, so I don't know everything about what's going on. And that is a little frustrating in that I knew, I built the portfolio at Iowa, and I hired the folks at Iowa. And so I knew everything about that portfolio. And I would argue that I probably know that portfolio better than I know our portfolios here. And so it's a learning process. And that's quite honestly exciting to be able to do that and constantly learn. So I'm doing that and kind of going through that, talking with the team. It's a very strong team here. Jen Cunanan recently got promoted to deputy CIO, and she's been here a long time and just my right hand here. And so it's a great process developing with the folks here and learning what's going on here and the great things that are happening in the state of West Virginia and West Virginia University.
And maybe you could talk a bit more about what the objectives are for the West Virginia University Foundation. I mean, some of them are presumably obvious, but there may be some nuances, and some people may not be familiar at all.
Yeah, every endowment is about the same in that, you have to beat a return target that is spending, inflation, and fees. Inflation is the same for everybody, but spending and fees are different for everybody. So spending can be 3% or spending can be 10%, and that's a big delta. And fees can be 0 or fees can be 2, and that's a big delta. And so when you stack all that up, generally endowments are 8% plus or minus 1%. So 7 and 9% is their return target. And that's, but that's a big difference, right? 7% to 9%, the risk you're going to have to take to get a 9% return is pretty massive compared to a 7% return. And so that's arguably the most alike that endowments are, is in the return target. Where every endowment differs, though, is in the risk tolerance. And so the risk tolerance of an organization varies wildly. And, PR risk can affect some schools that, small schools that you never heard of probably aren't that worried about PR risk. When you're the flagship university in a small state, it is a very big issue. And I think some of the Ivies are finding that it's a big issue for them as well. And so there's things like that we have to consider. Obviously, drawdown risk is a big thing. Liquidity risk is another thing that affects endowments differently. But everybody's kind of trying to solve a similar problem, but not the same problem. And the constraints that they have are also different. Some states where we're a private 501c3 foundation, but in some states they're not, right? And it's a public school, and those assets, the state legislature can come in and say you can or can't do something. And that you've seen that a lot with ESG in different states. And so there's things like that I can't control that I have to think about. And I say me, but that not necessarily in my seat, but CIOs might have to think about that. And that changes. The needs of the university can change. I think like donor giving also affects that. Like we're seeing an uptick in non-endowed giving as universities need more immediate use dollars, and endowments aren't growing as much as they used to. I think that's a national trend, but that's something that we have to think about because historically, you would think as gifts flow in, that is creating liquidity. And if you're not getting those gifts, then, what years ago, the 40% private rule where everybody thought 40% was the right target, that might be too high if you're not getting new gifts in. So I think fundraising has a piece in this equation as well, and that might be evolving, and it certainly is different from one school to another. So there's a lot of different things that each endowment faces. They're all similar, it all kind of rhymes, but when I talk to my peers, they're dealing with the same issues, but at a higher or lower level than we are dealing with them.
And where does the West Virginia University Foundation fall along the lines of targeted return, risk, and other similar parameters?
Yeah, we're probably closer to a 7% return than a 9% return. We've reduced our spending because we're, the thought of that, and this wasn't me, this has been done over the last several years, but everybody, stock markets are at an all-time high, rates are high, but really kind of average what the historical rates are. So you're not going to get much price appreciation, although maybe next week the rates drop a little bit. And there's been a lot of money flowing into hedge funds, a lot of money flowing into private equity. So there's a broad belief of my peers and I get together that returns are going to be lower. We're not dissimilar there. So I think there's a kind of a race towards let's talk with our constituents so that we can lower that required return. Maybe you lower the spend, maybe you lower the fee. We can't control inflation, but everybody's kind of there. So that's kind of how we think about returns. On the risk spectrum, what we've learned from COVID is it's the volatility of returns that's very concerning to campus. And so if you have a spend policy that is 5% of a 12-quarter moving average, and a March 2020 event happens, well, your average drops, right? Because your market value is going to plummet, and all of a sudden the dollars that you're sending to campus are different, and they're not going to be more, right? They're going to be less. And generally what happens is they're less when campus needs more and more when campus, I don't know if campus ever is worried about too much money. What we do is we do a percent of a 12-quarter average, but we had a meeting a couple of weeks ago where we declared spend for fiscal year 27. So we know what that dollar amount is. We're committed to what that dollar amount is for that fiscal year. But we just started the 26 academic year, and we're finishing the first quarter of the 26 fiscal year. But we've already told campus this is what you can expect from a spending standpoint. So that's very helpful to them. The last thing you want to do, particularly in March of 2020, you're awarding scholarships at that point, right? Like, April is when kids declare where they want to go to school, and you're trying to say to somebody, hey, we want you to come to West Virginia. Here's your scholarship dollars. Well, if that number changes and that student enrolls, we have to award them some money. We promise them that money, or somebody has to tell them you don't get as much. And nobody really wants to have that conversation. So that's one of the risks it's the volatility of returns that is a big issue to us, but also that max drawdown. We don't want to have a scenario where we lose 30%. So we put some things into place to guard against that based on lessons learned. But the risk piece is probably always evolving. And I think, it's a lot from talking to our campus partners, talking to our board and committee about what do you think the risks are? How should we address those? And that's where that becomes the creative part of my job is I take all those inputs and have to create an endowment portfolio. And that's why it might be a little bit different here than other schools. But again, it's similar.
And that's a nice segue to, and this, obviously you mentioned, I think it's 14 weeks, if I didn't have that wrong, that you've been there, but maybe it's a question more structurally or as to how you look at things. How do you innovate to improve alpha from an investment perspective? So it could be, what you plan on doing if it's not what you've already started doing.
Yeah, I think one of the things I say about small teams, and I would say most endowments are small teams. There's a couple that have 20 plus, but most of us are single digit people on the team. And there's 7 on our team. So we're a small team. And so one of the things that you have to remember is we can't do everything. Or we can't do everything well. So we're not looking for alpha everywhere. What I'm trying to do now is determine a couple things. One, where is my staff interested in finding alpha? Because it's one thing for me to say, I think we can find alpha here, but if nobody on the team is that's interesting to them, they're gonna resent me or not put their whole heart into what they're doing. So I'm trying to see where do you enjoy spending time? And then there's where do we have an edge? Because we're not going to have an edge everywhere in Morgantown, West Virginia. And that's probably true regardless of if we were in New York City, we wouldn't have an edge everywhere either. We might think we do because we're in New York City, but I would argue that you wouldn't just because you change the location of your office. And so we're trying to find that out of where is the edge. And maybe historically, when I was underwriting managers, I had an edge and I can instruct people about the things that you need to think about when you're looking for something in, small. We did a lot of small buyout funds at Iowa. And so we felt that we had an edge there. And I built a lot of that. So maybe that edge was me, but maybe I left that behind in Iowa City. And so we're trying to figure that out of that the overlapping Venn diagram of where is the team interested and where do we have an edge? And if we don't have an edge, can we access the beta? Are the median returns of that asset class enough? And so I mentioned the 7-ish% return, that cost of capital, that does limit the strategies that you can invest in. If they aren't going to get you an annualized return of 7%, but you're going to lock up capital, I don't know if that's worth it, right? And so you have to think about liquidity and other things you need. And maybe if you're building a portfolio, you can take that single-digit IRR fund and invest in that because you don't have to worry as much about liquidity. When you're closer to that limit of liquidity, whatever your target is, then you're kind of cannibalizing some things because you have to hit certain return hurdles. And then one of the things that we think about is when you're looking at certain strategies, are we really seeing the returns there? Maybe this happens with real assets in organizations wherein you don't have unrelated business income tax offsets. You'll have to pay UBIT on some of those real assets or leverage strategies. And while that doesn't affect your returns, it does affect the endowment's growth. And when you think about, I mentioned the spending, inflation, and fees, like the endowment has to grow above that. Now, generally people think about that from investment returns, but if all of your investment returns are eaten up by taxes, your endowment's not really growing, right? And so I don't think there's a situation where your returns totally eaten up by taxes, but we'll see. And so, we're thinking about that of the after-tax returns of these strategies, are they enough for us to take illiquidity risk? And we're constantly monitoring the tax situation where, Congress passed a tax on endowments. And so that doesn't affect us today, but it might affect us tomorrow. And what types of strategies would we invest in if that were to affect us? And so we're thinking about those things in the back of our minds, but not necessarily the forefront since it doesn't hit us today. But generally, they don't stop taxes. So I would think at some point it will affect us.
Right. And what about innovation from an ESG perspective? Obviously, ESG has been somewhat cyclical. Maybe an administration ago, it was all the rage, and now in the current administration, it's the opposite. And obviously within that, there are three components, and within those three components, there are a multitude of components, and everyone has a different definition and view. And I don't think anyone would argue good governance is important. So that I think is largely uncontroversial. But where does the West Virginia University Foundation stand on some or any of this?
Yeah, we don't have an ESG policy, but it's funny because I think people forget about the governance aspect of it. One of the arguments for passive ETFs is that you can't win in the active market, but you can choose better managers, right? So that governance piece of it, that's part of what active management does. But it often gets overlooked. And I think one of the things about private assets is, particularly when you're doing buyout or control buyout, maybe control growth, you own that entire company. That's pretty good governance. When you're investing in some of these strategies, like venture, is kind of on the opposite end, right? Entrepreneur is going to have the control of that. And so you could make an argument that if you were very pro ESG, venture is probably not where you're going to spend a ton of time. And so I never heard that argument. I always thought that was interesting, that never came up. But there are strategies that you definitely want to have control, and that leads to good governance. On the environmental stuff, I think we look for the total return. And so if it's a wind farm or an oil well, if it gets me the return, I want to diversify returns, but it has to get the return. And I think what's interesting about ESG, when you talk to ESG managers, they say the same thing. They're not saying like, well, you should do this, but you're going to get a lower return. You mentioned it was cyclical, and it is. There's going to be times where an ESG fund is going to outperform a non-ESG fund. That's just investing. That happens all the time. And when one outperforms the other, that's when people will be for or against the thing that isn't outperforming. And that's just the nature of investing. So we don't really have a policy other than we want to make sure that we have a diversified portfolio that meets our return targets.
Yeah, well, to your point on venture, I mean, structurally, I'm a proponent of venture, and cyclically, I also am a proponent of venture at this time. But that said, the governance is generally awful. I mean, if you look at, I don't have the percentage at my fingertips, but a material percentage of the companies have, end up, for example, when they go public, which to this day, if you look at multiple of the FANG stocks, have Class B super voting shares, which from a governance perspective, it's not one share, one vote, or equality. It's far from it, right?
Yeah, you think of something like Tesla, where I think the pay packages they're proposing, if it all pays out for Elon Musk, he would own 25% of the company. From a governance, just you look at through the governance lens, that doesn't sound great. But if you see the metrics, I can't remember. He would be worth $1 trillion or something if he did that. So the company, my math would say, would be worth $4 trillion. If he owned 25% of it. And so I don't think anybody would be upset if you bought Tesla stock today and ended up with a $4 trillion market cap. And so I think a lot of that, it's a sliding scale. And so I think what like venture during when some of those CEOs were just not great actors, people overlooked some of that because they thought there was potential there. And that only lasts so long. That's cyclical too. And that reversed. And I think maybe people are putting things in place today, but the exchanges kind of said we don't really like it if you do the kind of Class B shares like you were describing. So the market adjusts to some of that stuff, and I think what we're going through now is an adjustment. It might be maybe we swayed too far in one direction, we're going to sway too far in another direction. Somewhere over the long term we'll be in the right spot. But as an endowment portfolio, you're not going to put all your eggs in either basket. And so, if you're a foundation that has an ESG mission, yeah, you might. But if you're a university endowment, you probably won't do that. And you probably won't swing the other way and be like, we're never going to look at ESG. You're going to look at it because if you think the returns are there, then you should think about investing. Now, if there's a law that says you can't, that changes things. But I don't think the laws say you can't do ESG. I think they generally say, you can't accept a lower return because something's ESG. And I've never met an endowment CIO that has been willing to accept a lower return for any reason.
Yeah, well, and to your point, look, it gets to one's fiduciary duty. Some time ago, I worked at a Dutch pension, and our fiduciary duty had responsible investing embedded in our fiduciary duty in our statement. So we actually were in the rare position where we could do that, but that's because that was the structure of the organization. But to your point, yeah, that's the exception, not the rule. But moving on in the name of time, how about innovation from a technology perspective, and anything interesting there, either in your portfolio or that you're investing in?
Yeah, what's funny is I described my technology budget at Iowa as $0, and it about what it was. And so when I got here, I was happy that we had technology investment. So we had some software solutions that, at Iowa, we were saving all the statements ourselves, where we have technology solutions here. And so that's one way. And I think there's a lot of endowments, probably the majority of endowments that have investment offices that do that. And we've got a sizable portfolio in venture that's trying to take advantage of AI and innovation. So that would probably be the primary way we do that. I think one of the ways that's been interesting on AI in particular is up until this year, because the Magnificent Seven aren't leading the way this year, the easiest way to make money in AI was to invest in those 7 stocks. And so what's ironic about some of that is that the smaller schools that had higher US equity exposures and probably no VC were really making a lot of money in AI and innovation from an investment standpoint. And so the schools that maybe made more money in VC or had a higher weighting in VC haven't been able to monetize that yet. Now, OpenAI is certainly worth a lot of money, but that hasn't been monetized. And so I think that's an interesting aspect of kind of the VC market today. And that is absolutely where innovation comes from, is the VC market. But it's been a tough road, and really VC is a poster child for everything that's going wrong in the private markets, and that the durations are extended. We invest in that way, and there's interesting things going on. I'm not, it is my 14th week, so I can't, tell you exactly what all those companies are in the portfolio. There's some really good ones, and we're hoping some of those go public so that we can get some monetizations. But I think that will be, for every endowment, probably, that will be a harder road to go down. While everybody is excited about the innovation that's going on, most endowments are overallocated to privates. So that incremental dollar is that much harder to invest. And I don't know where that vacuum gets filled in the VC space, because there's so many more VC funds than there were. They're saying this is a bubble like 97. If you look at how many funds there were in 97 and how many dollars there were in VC, it certainly is a bubble from that perspective, but it's been building. And I think largely that's been driven by LPs, that, limited partners that want exposure to those asset classes. But at the end of the day, we will have to see returns for that. And so I think everybody's got innovation in some way, and it's just a matter of time. There will be innovation. Maybe a different way to think about that is something that I've been pondering on the VC front. VC will innovate a way to get monetization. Think of it like continuation vehicles on the buyout front. VC will have to, because if you've been at a VC firm for the last 5 years, you don't have a lot of liquidity back, and you're being asked, you got to raise another fund, and you got to commit to that fund as a GP. What's the GP commit? And you don't have any money, right? It's all tied up in the unrealized carry of your fund. And that problem will get solved. And I think LPs, we have to be a little bit guarded in how we have these conversations with the GPs. And we're one investor. I don't carry the stick for everybody here, and I can't tell every GP what to do. We're a small organization here. And so, but what will happen is, my guess is what will happen is VC funds, no different than buyout funds, they will innovate a way that will be more advantageous to them than the limited partners. They have more expensive lawyers than limited partners do. So they're going to figure out innovative ways to get liquidity. There's some easy solutions that we haven't seen implemented at a large scale yet. You can have a secondary market for some of these privates, and folks can do that. You are seeing some innovation on the early stage front, in that they will take some realization off the table. They won't necessarily reinvest to keep the pro rata share. They'll get that 1x back, 2x back, and keep some money on the table. So they're innovating the way that they're thinking on that. But I don't know. I don't think that's the end game of it. I think they'll figure out a way, and it's just how much does that advantage them over us?
Yeah, look, you made a lot of points, but it sounds as though structurally we're on the same page in terms of the future value and benefit of innovation from VC. Getting maybe slightly more granular, what do you think's most interesting from an investment perspective at this time, in light of your objectives, constraints that you described earlier?
Yeah, that's a good question. I think there's a lot of stuff that's interesting. It's probably easier to think about the things that aren't interesting. And I think certainly I am a believer that size decreases returns. But I think also you have to think about, does to use VC an example, you raise a $5 billion late stage VC fund. I don't think that's going to return a 3x.
Yeah, I agree.
I think it'd be really unusual outcome. But, I say that, and I kind of joke about this with the team internally. Like, every VC fund you meet with says they're going to return a 3x. If they are a 3x, they're top quartile on almost any vintage year. And it's really hard to do, but every VC says they're going to do it, which I find kind of unusual. But that $5 billion fund might have liquidity faster. And so maybe you get a 2x, a similar return to what you could get in buyout. You might be okay with that. I don't know. I don't think we are. But
not if it's higher risk, right? And if there's higher insolvency and other risk, you shouldn't be, right? You should demand a risk premium, I would think, or I would have.
I agree with you. I think, but there is a school of thought. Well, even if the return's the same, it's a diversified return because your end game is the same. You took a different path to get there, and so you can make that argument. I agree with you 100%. I don't think that's a great argument. But that's one I heard when I was a consultant about why you might do different things. So I think you have to understand that loss ratio. And what's interesting about VC right now, I think, is we don't know what some of those loss ratios will be, and they might be different. I think one of the things I've found interesting over my career is how few limited partners read LPA, limited partnership agreements, and understand how waterfalls work, and that for the most part, when private assets talk about a return, they're talking about a multiple. And so that multiple will get you an IRR. But using VC as the example, and this is VC is a poster child for this stuff, but you can do this in real estate, you can do this in buyout. If you're going to get a certain multiple return, that IRR is very different, if it's over 10 years or 20 years. And so multiple doesn't really get you an annualized return. IRR will get you one. There's no real correlation to say a 20% annualized return is an X percent, or 20% IRR is an X percent annualized return. But haircut it 25 to 50%, and you're probably in the ballpark of where that is. So I think that piece of it where, if VC duration is extended too far, then the IRRs are just unattractive. And so I would argue the median IRR is already unattractive to your earlier points. You've got a lot more risk in there. And so everybody has to really, it's not even a top quartile game in VC, it's a top decile game. And so what is the likelihood that you're going to have access to the top decile funds, regardless of who you are? And you could make that case. I say that private real estate is the same as private VC in that you have to be in the top decile of private real estate funds to make that return attractive. And you kind of have to do the same thing in VC, and nobody really thinks about it in real estate. You just invest in real estate. It's like, I don't know, 5-ish% of your portfolio. So you don't spend a ton of time. It's like, okay, this manager's good, whatever. And then you end up with your returns, like, you might have a top quartile manager and everybody focuses on top quartile. But I think there's an ongoing discussion about, is that enough? And that's kind of an innovation. You see it from the CAIA Association about total portfolio approach. And I think that is innovating folks of like, just because you're top quartile, if you're top quartile in a bad asset class, it's not enough. And so maybe you can avoid some of those asset classes and focus on ones where you might have an edge. I think what people historically do, though, is they all focus on the same asset classes. And in something like VC, if everybody focuses on VC, it's a capacity constrained asset class. So that just doesn't work, right? The math doesn't work for everybody in the world to concentrate into one asset class that's capacity constrained. And so I can make an argument where, small buyout, which outperforms large buyout, is a better place for people to spend their time. But my concern on that would be, there's a lot of baby boomers that are going to be retiring, and those businesses that are, the small buyout businesses, that's a big tailwind for buyout right now. VC, the innovation side, we're constantly innovating, right? And so I could see why you should be more VC than buyout. But I think at the end of the day, what matters is what's your ability to access the best managers in either one. It doesn't really matter if I'm right on buyout versus VC, if my only access to one or the other is fourth quartile. That's a bad journey. And I think people have to be more introspective of, do I really have an edge here? I go to conferences all the time where some endowment CIO will get up and said, we're all endowments. We all invest in top quartile managers. I'm like, that is impossible, right? Like there's 300 endowments in a room. Like it is impossible if they're all top quartile in everything they do. I like to think that we're top quartile in some things, and I think we are, but I think it's naive to say that we're top quartile in everything.
What's the biggest challenge you face now?
I think the biggest challenge that we face now, and there's new challenges every day, right? You never know, some executive order or some law gets passed and it limits something, or it changes the incentives of something that you might have done. If you were investing in the wind farm that got shut down a week or two ago, you didn't expect that to happen. And so there's that risk of what happens. And I'm not going to say that that's only the Trump administration. That's every administration does that. The previous administration was curtailing investment in China too. And so everybody should have seen that one coming. And so you try and have a portfolio that can be resilient to those things and recognize some of those things. But those are long-lived assets. The reshoring effort, I think that's positive for the country, but that's going to take a long time. And so that isn't something that can get solved today. And so, that's a challenge. Liquidity is probably the biggest challenge that endowments have right now, trying to figure out where that incremental capital goes. When are we going to get capital back, and have conversations with the GPs about what are you doing? What have you changed so that we can get capital back? And really, you need capital back too, or your organization's going to die. And are you thinking about that, right? Like if you can't raise another fund, everybody's going to jump ship. Now they're in a spot where maybe those folks can't jump ship right now, but that's eventually going to change. But that is a risk. I always think too about my team. I think we're a small team, so if somebody leaves, that's going to affect us. And we've got family offices that are attracting talent left and right. They're right now, family offices, as I understand it, are the generally the highest payers in the market. And they're trying to get the same talent I am. Our team here, I'm the newest person here, but we still have 12-year average tenure of the team here. So we've got pretty good tenure, but I still act as if any of them could leave. So I make this a great work environment for them, so that they enjoy working and come in and are challenged by what they're asked to do, and they enjoy what they're asked to do. When CIOs get together and we talk when cameras are off and recording devices are off, the number two things that we bring up are governance and retaining staff. And so those things aren't necessarily sexy for investment risk standpoint, but those are the biggest things. I think this organization has governance solved. I don't think that's going to go wrong here. And that was a lot of my interview process, was trying to figure out what's the governance like there and how do you think about things, and is there a difference between the board and management? And the board isn't manager; they're not managers, right? And so that's always a risk for endowments, and one I think doesn't get talked about. It gets talked about amongst us, and the interesting thing about both of those issues is they're very idiosyncratic issues. And so I have, I'm in Morgantown, my team's in Morgantown. We do have one person in San Francisco. But the constraints I have being in Morgantown are different than the constraints somebody has being in Iowa City. And we had a fully remote staff in Iowa City. That's how we got around that. I was the only one that was in Iowa City there. And so solving that problem the way we did at Iowa isn't the way we're going to solve that problem here at West Virginia University Foundation. And so it's the reason why these things don't get talked about a lot is because of that, because it's so idiosyncratic. And I can tell you how I solve this problem. That doesn't mean you can solve it. You can use that and solve it the same way. And that is a little frustrating when, we're trying to give advice to other CIOs, like, here's how we did it, but I don't know if it'll work for you.
Let's see, we're running out of time. So, hey, look, inflation's topical. It's funny. That's another topic that we've discussed over the past years in this podcast. And There was a time where it was very hot, and then there was a time where it cooled off, or seemed to be cooling off, and now it's, I guess, perhaps controversial again. Do you have a view, and how does that impact your portfolio or portfolio construction?
Yeah, I have a view of it, and it might be a hot take, but I'm kind of convinced this is true. And the high inflation period did nothing to dissuade me of this opinion. But I think the thing about inflation is, one, I don't know if it's a rule of inflation, but it seems like if you talk about inflation, eventually you're going to get inflation, right? And so it's almost like saying Beetlejuice three times or something. Like, if we talk about prices rising enough, people are going to raise prices. And so I think, I don't know what the direction of inflation will be, but I think what's interesting about how you invest, everybody talks about inflation hedges. And what I would always do is, like, show me the data you have that shows that this is a hedge. And they're going to say, you're going to show you some assets correlation to CPI, whatever, that's great. And it's over a distinct time period, right? And so let's say that's over 3 years. Well, I don't really care about 3-year inflation. I care about annual inflation, right? Most people care about what the annualized inflation number is. No, I don't hear on, whatever the inflation print was yesterday, they said this is what it was for the last 12 months, right? Very few reporters were leading with, well, the 5-year annualized inflation number is X. Maybe some did, but certainly not the majority of folks. And so when you're thinking about portfolio hedges, you got to be aware of that. The thing that you're worried about is the 1-year number. So what is correlated to 1-year inflation? And I don't know the answer to that. I think it's almost like a hypothetical question, because whatever is correlated to 1-year inflation over some time period, it's going to be a different thing that is correlated to inflation over some other time period. So energy was a good correlation to inflation in the 70s. I don't know if it was. When COVID hit and inflation was hitting, like, generally gas prices were pretty low. Then they increased, but they didn't rise with inflation. What did? Eggs and used cars. Well, how many people buy used cars every month? I don't like eggs, so I don't buy a ton of eggs. So, like, those things, they get headline numbers, but, like, am I going to invest more in eggs because that might be a hedge to inflation? So I think we think about it, and maybe it's a long-winded way of saying, I think a diversified basket of things is your hedge to inflation. But I'm convinced that any asset is positively correlated to inflation over some time period, and weakly correlated to inflation over a different time period. And so you just choose a different time period, and that can look very different. And if I'm a asset manager that has this asset, I know this, and I'm just going to data mine to find what those time periods are. And so what we would always do is ask, like, show me the data that you have. And sometimes what you'd find is, a 0.5 correlation is perceived to be strongly correlated or weakly correlated, depending on what they thought the allocator wanted to hear. So I'm not a huge believer in some of the data, like the anecdotal data that you see. If you show me the data behind it, then maybe I'll get behind it. But I think a basket of securities is your best hedge to inflation.
What's a good book you've read recently, or that were one of your favorites? Doesn't have to be on investing; could be about anything.
Yeah, my favorite book ever is Eiger Dreams. That's what inspired me to move out west. And I joke now that we had to move east from where we were to get back out west, because West Virginia is very mountainous, and it's similar in many ways to living out west. The most recent book that I finished, and this is controversial because I can't say that I read it. I listened to it on audio. And so I don't really, as I've aged, my tolerance of reading has decreased, but I still want to learn. So I listen to books now. And the most recent book that I listened to was Sheryl Sandberg's Lean In. And the reason why I listened to that book is there's 4 women on our team, and I didn't have women on my team at Iowa, and I wanted to understand better about how to manage them. And so I listened to that book, and it was very insightful and I think helpful to me.
Got it. We'll check them out. Haven't read either, but they both sound quite good. Okay. Well, any last question? Anything we haven't discussed that you think is on your mind or topical, or that other investors or allocators would be interested in?
I think everybody's trying to figure out what's going to happen with liquidity. So I think that's the biggest thing, and we discussed that. I think. Yeah, I don't think there's anything there that we haven't hit on that's a major topic for folks.
Okay. Then, Jim, on that note, we'd like to thank you for the interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for what one of our more thoughtful allocators is thinking about and how we may all benefit from this. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.